Welcome back, you legends. I'm Dr. Cal, and if you've noticed, I sound like a southern gentleman who's had one too many whiskeys in his days. That's because I've been sick, everybody. That's why I haven't uploaded for the last week or so. I've actually gotten COVID. I was hospitalized with COVID pneumonia, as well as pulmonary edema and bacterial pneumonia on top of that. This is what my x-ray looks like. I had nasty bacteria infiltrate my right lung, and I was very sick, to be honest. I did get out of the hospital just a few days ago, and I'm feeling so much better now. My voice is still obviously shot. I haven't ever sounded this raspy before. Uh, so please bear with me in this video. I'd like to thank everybody in the trading community, really our Discord family. Everybody's been so kind. Thank you everybody for your kind words, for your prayers and your thoughts. I got a lot of messages from a lot of people, just checking in. Some people giving me tips on how to handle different uh, different symptoms, COVID related treatments and things like that. So thank you so much, everybody. You've been an absolute blessing, and I'm so thankful for everybody. Um, so without any further delay, let's get right into this video. Today was a nasty day. Look at this, 1.7% down across the board on all three major indices. And if we take a look at the stock market map, really red all over the place, except for just a few pockets of green in consumer defensive, as well as Nvidia. Nvidia did announce a new product just yesterday. It's a horrible product, actually. It's really bad. It's not a good product at all. I have so many issues with it, but I'll just talk about that in a different video. But they're resorting to some really terrible marketing tactics for their new product. And by the way, I am an Nvidia investor. I do hold a significant portion of shares in Nvidia, and I didn't like the product announcement at all. With that being said, let's take a look at the different sectors again. Cyclicals, communication services, financials, lagging. You don't want to see these sectors lagging. This is a very typical risk-off move, again, with consumer defensive and utilities leading. So we're seeing defensive posturing today, very obvious defensive posturing. Let's take a look at the daily chart. This is the daily chart for the S&P 500. And we actually looked okay for just a tiny bit, right? We had this nice bounce to the upside. In fact, I was actually waiting for the S&P to move up to 390. That was my first price target. And for it to go back to 395, that was my second price target. But it failed just short of 390 at 389.36. Following the FOMC surprise today. Well, it wasn't a surprise to me, but it was a surprise to the market. And it was this, guys. It was the interest rate projection for the terminal rate. The market was pricing in 3.8 to 4% by the end of the year, and the Fed came up with a 4.4% terminal rate projection by the end of the year. This indicates, guys, that there will be more aggressive rate hikes coming this year. Not only that, they've raised the terminal rate for next year to 4.6%, which also means that they expect to not only raise rates next year, not just this year, but next year as well, but they also intend to keep those rates at 4.6 for the entirety of the year. And again, those are just projections. Anything can change on a dime just like that. But these are very bearish projections for the market. The market was not anticipating a 4.6% federal funds rate for the entirety of next year. That would be very bearish. That's such a high rate that things are bound to break. In my opinion, though, the Fed will actually go to 5%. I think they will revise these numbers again in the next meeting, and I think that the next year the projection will be 5%. So I think in the next meeting as well, the market will be surprised again, and it will not look pretty. So this is the 2-hour chart. Let's take a look at the 1-hour chart. The 1-hour chart really had a hint here, guys. Look at this. This was once a massive green candle. And when I saw this reverse all the way down to the downside, and in the very last 30 minutes of trading, We had this massive second dump. This is a very bearish looking candlestick pattern, guys. We rallied to the 50 period moving average on the 1 hour chart. We got rejected. We had this nasty rejection tombstone candle, and then we broke to the downside. And look at this volume. Remember, guys, the last hour of trading is actually the last 30 minutes of trading. This is a 30-minute candle, not an hour candle. And we had this massive dump just in 30 minutes. So guys, I was anticipating a bounce to the upside. I did in fact enter here, and we did get that bounce to the upside. We got reversal yesterday, and then I did anticipate again a bounce to the upside. We did play the bounce to the upside. I ended up getting liquidated by my stupid broker, Interactive Brokers. I hate you guys. I will never use you again. But funnily enough, that liquidation ended up being a blessing in disguise, because I got liquidated at a 50% profit. I was at a 200% profit. So I did get liquidated at significantly low profit than what I was hoping for, but eventually it didn't matter. I get liquidated at a profit, a 50% profit on the day, and that was good enough for me, because look at this massive sell-off today. And so I did, guys, play this move to the upside, and then I played this move to the downside, right? I got short here, and I played this to the downside all the way here, guys, on the 16th. I took profits on my shorts. I got back long. I took profits again today. Well, I got liquidated, and I now plan to go back to being short, because look at this descending wedge. This was a bullish pattern. We also had several bullish divergences between the S&P and the HYG, for example, right? We had a low here, while the S&P had a lower low yesterday. So that was a bullish divergence. It did play to the upside, and then it got reversed. And so in my opinion, that bullish divergence is now played out. It's done, and the market has made a decision to the downside. It closed at a very logical level. Look at this bread box. It closed at this gap fill level at 378. I was waiting for this gap fill level for quite a while. I actually expected the market to fill this gap yesterday, for the market to move to the upside today, but the opposite happened, and that's actually more bearish, because you don't want to see the market move up and then reverse. If you're a bull, you would have wanted to see the market fill this gap and then move to the upside, but the opposite happened. And so again, guys, I'm now turning back to being bearish, and I'm getting prepared again to open more short positions. By the way, guys, if you're interested, I do post every single trade and investment that I make in real time in the trading community. It's $20 a month. If you want to support me, that's the best way you can do it. And even though I was sick the last week, I did cover the market live in the trading community every single day, except for the day that I was hospitalized. Now let's take a look at more levels. Let's take a look at the weekly chart, guys. Let's take a look at the weekly chart. Look at this nasty rejection to the upside. We're now moving down. We have this tombstone looking candle. This black line, guys, is the weekly moving average at 373.8. There's a very real possibility we overshoot to the downside, but it remains to be seen whether we will overshoot this week or next week. Seasonality tends to be very bearish towards the last week of September. We tend to see a lot of selling towards the last week of September. And so over the next, let's say, 7 trading days, I think the market will be significantly more bearish than the previous 4 trading days. So be prepared for more selling. We are getting a bearish crossover on the weekly chart. This will trigger a lot of algorithmic selling as well. And so I expect more selling well into October, to the 10th of October, when we'll have the FOMC minutes come out. Well, actually on the 12th of October, when the FOMC minutes come out. There's a very good chance, guys, that we will retest the lows towards the beginning of October, perhaps even overshoot the lows and hit this 200 weekly moving average, which is sitting now at, let's see, this beautiful blue line is sitting at $357. So I think we will probably not only test the lows, but take out the lows. I did talk about how bearish it is when the market rejects at the 125-day moving average. This rejection, guys, is so significant. In fact, the last 3 times this happened over the last 20 years, it only happened 3 times. And the sell-off that came after that ranged from 10 to 15 to 20%. So let's see, a 10% sell-off would take us down to 370. That will be the bottom of this consolidation range. A 15% sell-off, guys, will take us down to the look at that, beautiful, to that 200 weekly moving average. A 20% sell-off, everybody, will take us down, let's see, to $330. This level has been talked about a lot by big hedge fund managers, including Scott Minerd of Guggenheim, who's, by the way, one of my favorite economists and investors. He plays both long and short. He's not a perma bear or a perma bull, and he's saying 330 is in play. And I actually agree with him. I think 330 is a possibility. I don't know if it's a likelihood, but it is a possibility. And I do intend to play the move to the downside, but I'll be playing it much more conservatively to the downside. You can still play it conservatively to the downside, guys, and make substantial profits. I'm talking 100%, 200%, 300% in profits, even if the market just retests the lows, or even if the market just goes back to 370. Okay. So with all of that being said, we did have a lot of bullish divergences. These bullish divergences have now played out. I think they're played out, and I think the market is now ready for the next leg to the downside. From the current levels, guys, I think we have anywhere between 5 and 10% to the downside from the current levels, and that would take us again to these to the June lows. $330, guys, makes sense because look at this. We have this consolidation zone right here, which ranges from 350 to 320. So 330 actually makes a lot of sense. I also have this trend line, guys. If you notice this trend line breaks the price action in the S&P towards bearishness below and bullishness above. So even if we retrace back all the way to $330, let's say by October, we will still be above this trend line, and the market, in my opinion, would still be bullish. In fact, even if we go back to $330, the PPO will likely still form a higher low, and that will make for a beautiful entry for that holiday November-December rally to the upside. In fact, let's take a look at the seasonality chart. And again, we did have this bounce to the upside in the middle of September, and I did warn that the second half of September tends to be very bearish. We're now seeing that sell-off. Towards the beginning of October, we tend to see some buying. Then again, towards the middle or the latter third of October, we tend to see one last sell-off. November and December tend to be very decent months in midterm years. Right after the election, we tend to see some nice rallies. And in fact, guys, when the government is broken up, where the House, for example, if the House gets taken over by the Republicans, that will be more bullish for the market, because with a bifurcated government where the Republicans take over the House and the Democrats keep the presidency, there's really nothing that can get done in Washington. We'll just get more gridlock, and gridlock is actually good for the stock market. Let's go back to our friend, the HYG, the high yield bonds, the smart money. The smart money has now made a new low. This invalidates the bullish divergence that we had over the last few days. We've now made a new low. And so this might, in my opinion, signals more selling across the board in the stock market. Let's take a look at the VIX. The VIX has this really, look at this absolutely enormous indecision doji. If we see a break to the upside tomorrow, that will signal more selling. If we see a break to the downside, that might signal some more chop before more selling comes. I'm leaning towards more volatility, more selling. We do have this trend line coming in at 31.5 on the VIX. We'll probably overshoot that a little bit to 32. Possibly by the end of the month, we'll see. And just look at this. If we go to 32 and let's say we retest the lows, that will still be significantly lower than the prior sell-offs that we've seen. And that overall will be bullish for the market, because it means that we'll see a bullish divergence between the VIX and the price action on the S&P. Let's take a look at yields. Yields actually went down on the 10-year today. This is again a late stage collapse behavior where we see the 10-year yield actually move down while the 2-year yield move up. This tends to increase or deepen the 10 to or the 2-10 yield curve inversion. So we're getting a deeper inversion, and as this inversion deepens, it indicates a more severe recession is coming. The deeper this goes, the worst will be off, let's say in the next 6 to 18 months, probably closer to 12 months, because we had the initial inversion in March. So I think within the next, let's say 9 to 12 months, we'll have one hell of a recession coming. But before that recession, guys, I actually think the market might start to rally, especially if the CPI and PPI, as well as the PCE, all of these inflation figures, if they start to roll over more, if we start to see core inflation come down even more, that'll be bullish for the market, because it'll allow the Fed to ease on the interest rate hikes. And if the Fed begins to ease on the interest rate hikes, if they stop raising rates, that'll be bullish for the market. That will be interpreted as a Fed pivot, and the market will probably have a nice rally to the upside until that recession really smacks everybody in the face and we see that massive collapse. Let's take a look at the dollar index. Just look at this absolutely enormous candle. We just had a bullish crossover, and we had this massive candle following this bull flag. The dollar just looks unstoppable at this point, right? It looks very, very strong. With that in mind, guys, look at this. We've made significant successive higher highs, while the PPO has actually been making lower highs. So we've been building out this divergence, which to me indicates that the dollar index over the next, let's say, several weeks will begin to hammer a top. But before then, we could still see even a quadruple divergence, right? Where we get another divergence, another high, and another low on lower high, on the PPO, and perhaps that will end the bull run in the dollar. What is also hinting towards something like this is gold, guys. Just look at gold. When we see the dollar move up, we typically see gold move down, but we're seeing gold actually moving up. I'm still waiting for a bullish crossover on gold, and for that a beautiful bullish divergence to play out, where we had a lower low on gold and a higher low on the PPO. But I'm waiting for that bullish crossover to enter my position. And look at this, guys. Long-term bonds, TLT, it's actually moving up. Bonds are moving up. We're now getting a bullish crossover. And again, this is late stage collapse behavior. We tend to see bonds beginning to outperform the dollar and equities towards the end stage of sell-offs. And usually, guys, this is the time when we get the most severe and the fastest and most aggressive sell-offs. And so a retest of the lows, even lower than that, 350, even 330, is definitely possible. It's not impossible. It is definitely within reach within the next, let's say, 5 weeks of trading. We'll see what happens. Let's take a look at Apple. Look at this. Apple is down 2%, again underperforming the NASDAQ and the S&P. I think Apple will continue to sell off significantly to retest this red demarcation line again. Bullishness above, bearishness below. Even if we retest it, that will still be overall bullish for the market, because even if we retest it, let's say in October, and we take out this low, that will still form a higher low on the PPO. We'll see if that happens or not, but I suspect that we'll see something like this, where the PPO makes a higher low and Apple either takes out the prior low or retests the prior low. Let's take a look at Tesla. Tesla is finally showing weakness. We're now seeing this tombstone formation, right? We had a rally, we had a rejection at the top, we had another rejection and a massive sell-off, right? This is a tombstone formation where we rallied, rejected, and then we had a sell-off. This is a very bearish development. I think we'll get a bearish crossover very soon, and October I think will be very negative for Tesla. especially around all of what's happening with the Twitter versus Elon Musk lawsuit that's going on. If the Maryland court rules in favor of Twitter, that's going to be very bearish for Tesla. And this to me looks like a triple top formation, right? With a significant bearish divergence where we had a retest of this level, this $310 level 3 times, with the PPO forming lower highs every time. So this is very bearish, guys. I still think Tesla will go all the way down at least to $250. Now let's take a look at fear and greed, everybody. Look at this reading 31. We're getting very close to extreme fear. We had that nasty rejection of the 125-day moving average, and I did cover that in the previous video. Please check out the previous video. I talk about the prior times in history. It only happened 3 times in the last 22 years, and it was absolutely horrendous results. After every time we had significant selling. Stock market stock price strength is declining rapidly. Breadth is also declining. Put to call ratio is declining, and this is a contrarian indicator. People have been buying calls, and today's sell-off will lead to more selling, more put buying, and so I think we'll see a higher high on the put to call ratio. Market volatility, we had this bounce off the 50-day, and again, guys, nothing good happens for equities when the VIX is above the 50-day and is moving up, so more selling is coming for sure. Safe haven demand, bonds are now outperforming stocks solidly. We've seen the TLT now moving up, while the S&P and the NASDAQ and the Dow selling off considerably. Yield spread between junk bonds and investment grade is widening. People are dumping junk bonds and hopping on the safer investment grade bonds. Let's take a look at the economic calendar. Again, we talked about the federal funds rate today. Came in as expected at 3.25, so a 75 basis point hike as expected, in line with expectations. But the projections went up, and I think they will go up even further in the next meeting. Watch out for the next meeting. What do we have tomorrow? We'll have some jobs numbers tomorrow, and Friday we'll have the manufacturing PMI for the S&P 500, as well as Fed Chair Jerome Powell coming back to speak and crash our stocks again. This is now what, Crash Farther Part 3 or Part 4? I can't keep track. Nearly every single time Chair Powell speaks, the market crashes. That's why I've nicknamed him the Crash Father. And so the Crash Father has returned, and he's crashed stocks again as expected, really. That's all I have for you today, guys. Thank you so much for watching, supporting, and for sticking around. Catch you in the next one. Bye-bye, everybody.
Oh, wow. Wow.